I'm Ryan and Deidre. I think we're live, but since this is our first version, there's no like Jimmy Kimmel Tonight Show intro. Thank you guys both for making time on a Friday to chat with me. This is you're the first, so this is like experimental, unscripted. But you know, what prompted it was just I've had so many amazing conversations with both of you and others over the last few months, and I thought it would just be fun for others to hear some of the things we're talking about life and work and, you know, everything else. We only have a half hour because that's sort of where people's attention spans go. But at some point, maybe we'll expand the format.
Well, tell that to every Joe Rogan listener who can sit through 4 hours.
I know. I'm a huge fan of Joe Rogan, but I will admit after like the first hour and a half, it's like, okay, are we going to?
No can do.
Let's jump right in and maybe I'll ask a question of you, Deidre, because you and I chatted about this last week and we've chatted about it several times over the last few months. But like, one of the questions I get a lot is I've been tweeting about mental health, and it's something I probably never tweeted about until this year, but it's really become front and center for a lot of us. Can you just talk about sort of, I know you've been thinking about it a lot. You've been doing a bunch of things with your teams. And by the way of introduction, folks that are logged in, Ryan and Deidre are both running venture-backed companies, repeat founders, been doing technology startups for over a decade, and both of the companies are very successful. Both of them are valued at well over $100 million, and I think in the pantheon of entrepreneurs are at the greatness level and achieving even higher levels of greatness. So that's the intro that I'll give. But Deidre, maybe just talk about, I don't know, mental health, your view on it, what's going on inside the company.
Yeah. I think this year CEOs have to lean into and really, I think, take, responsibility for the mental well-being of their teams. And it's a crushing year in a bunch of ways, right? I had a big team in Portland, San Francisco, and of course across the rest of the US. And it's like layer on layer on layer of soul crushing, soul dampening experiences without the ability to connect with other human beings that easily. Ton of folks on my team have family members, parents, whatever, that are sick and far away, and they can't get there. And those things have like psychic wear and tear that's very real. And so I've tried to be really in front of giving people time and space and increasing the resources that the company makes available for mental health, and then stepping up the pace of things we do to buoy that and create what I think of right now as a village that includes our kids, right? Because really we're all in it together. Couldn't be more literally all in it together. Zoom call to Zoom call. Right?
And what are you doing for
my
yourself
job now?
What are you doing for yourself? Because there's the obligation you feel as a founder and CEO to take care of the community, but then there's also like that moment where you're like, you know, pretty stressed out yourself, getting headaches. I mean, you know, it's not sleeping. Like, what are you doing for yourself?
Yeah. One thing that is, so I traveled like 75% of the time for easily 10 years. And that like really competed with my need to like ride my bike and run and like be outside. And so this year for me has been fantastic, minus the fires, because I really can do 7 days a week instead of maybe 3, right? And so I live on the top of a hill, so to go on a run, I have to run hills. I'm telling you, like, attacking a hill is the best possible thing for a little soul crushing experience.
Right.
I wasn't able to exercise, as none of us were in California kind of last month. And it just, the grading gets very real. And that's a big deal.
Time differently overall? Are you allocating time differently throughout the day than you were a year ago?
I'm not very good at this. I literally work all the time. Yeah. And somebody was saying the other day, like, oh, you know, it's like you drink the Kool-Aid, but then you have a sugar crash. Like, no. Actually, growing a business, and like right now we're growing really fast. Growing a business is not Kool-Aid to me. It's air. Yeah. I never have a crash for more air, right? I just feel better with more air. Yeah. And so my day is really long, and
but you thrive on it. You thrive on it. Yeah. What about, hey, Ryan, I know on your end, and I'm happy to throw that same question to you, but I also, one of the things you and I have talked a lot about over the last years is some of the things that you've learned as an entrepreneur. And you've been tweeting lately about how different your current experience is from your prior experiences. And can you maybe just share a little bit of that? Because I think it's I know I was way better on my second company. I learned a lot from the first one, which was a disaster. But like you're tweeting out some things, and if you don't follow Ryan or Deidre, I certainly encourage you to. But like you're tweeting out some pretty cool stuff that's a little bit of inside baseball about like, hey, here's what I did last time, and here's the revelation I've had this time. Can you just talk a little bit about that and sort of how's that come about?
Well, yeah, I mean, I think the biggest thing is now on the third company, like I have this library of fucked up stuff that, was largely self-inflicted, right? Like, and what was actually really interesting was when we were in the depths of the lockdown and the pandemic, and like every company, we're making our sort of like three different plans of like, doomsday and optimistic and somewhere in the middle or whatever. And I remember Jamie, our VP of people, we kind of looked at each other and we're like, we did this a year and a half ago. Like we pandemicked ourselves, right? Like, we sort of got like right after the Series B, we'd kind of gotten a little over our skis on sales, and the ops and the tech wasn't quite there to keep pace with it. And so we had to like make some really hard decisions and potentially think through some scenarios that weren't that sweet. Fortunately, we buttoned everything up relatively quickly and got back on our trajectory. But I think as we were going through the initial shock of COVID, the thing I kept thinking about was like, for many startups right now, COVID didn't do anything worse than a bunch of the shit that you've already done to yourself anyways. And so I think a lot of companies were actually far better equipped to handle like the shock of what was happening in the world. Like for non-founders, when you go to work every day, you basically often are just sort of, told what to do. And it's like, here's your paycheck and, we have some stuff to do. But when you're working inside a startup, like, I'll give you an example. Like when my first company was an ad network, we sold it to USA Today in 2008. And we had this earnout that was contingent upon how much traffic we had from our partner websites. And I insisted on using this one vendor who I won't name, this ad network. And they basically just delivered malware all weekend to all of our publishers. Like a month after USA Today bought us. And so by Monday night, we had lost half of our traffic. Oh. And, and it was like, it was super gnarly. And like, that's like one of those things that like no one outside the company ever knew. They were like, 2 years later, we hit the earnout. Everyone's like, great. But like, no, like I nearly killed my company just by like picking the wrong vendor. Or like at Swarm, we built retail analytics software. We had an exit to Groupon that was really good for everybody. But even prior to that, we had a device that would measure the foot traffic, and our factory in China fucked up the soldering of the boards for the Bluetooth chip. So like we bet the ranch on the new hardware, and when our distributors started getting it, 1 in 4 devices was leaking battery acid through the box. You know what I mean? So it's like a pandemic rolls around, you're like, all right.
Yeah. It's
what else you got?
I guess though, like I feel like, and I remember when you called me last year in Q2 and you were like, hey, I've got some real issues. Like there's some stuff that's not working well.
Yeah.
You had a very kind of zen moment where and I think a lot of founders and CEOs are afraid to have that conversation with their board and their investors. You just talk about how did you get into that headspace of like, hey, I'm going to have this open conversation. We're going to figure this out together. Cause that's what it felt like to me. But how did you get there? Cause I find that historically, a lot of founder CEOs treat a board meeting like a sales pitch. And
you learned that the first company.
Yeah. So that's a great example. Like, so my first 2 companies, there was like the conversations we had internally and what we believed internally. And then there was the stuff we told our investors. And that is a completely wrong way to approach it. Like at the end of the day, when I sit in the boardroom between me, Jeff, Bob Goodman from Bessemer, and a couple other guys, like collectively we represent the ownership group of the business. Then obviously the employees own a certain percent of it, but like between myself and a handful of the board members, we own over half the company, right? And so it's like that's if you're going to be honest with anybody, it's effectively your ownership group, right? The partners in the business. And so when I sort of like every founder has a time where like something fucked up happens or they realize that they're in a little bit over their heads, and you literally have to make the call. Like there's an actual phone, you pick up your phone, you like have to just start calling board members and be like, hey, like there's like some stuff that's not that sweet. So what I learned from my first 2 companies though is that like the more you try to put Band-Aids over stuff and the more you just kind of kick the can, that's one of the most psychologically damaging things you can do to yourself as a founder, business owner, whatever, right? Because every night that you leave the office, no matter how good of a day you had, you're like, there's this thing that's going to eat us alive eventually, right? And so having lived through that and, you know, more or less.
Is there any way to find that out? I mean, Deidre, you mentioned that's the second time founder, but like, is there any way to find that out as a first time founder? Because I will tell you, you know, probably 80% of the people we back are first time founders. And the majority are more in the camp of, hey, I'll sort of squirrel away and figure this out myself, as opposed to, hey, let me bring in this group of resources. I might as well share what's going well and not going well, because we're all in the same boat. And I realized that, you know, look, we've all had, I personally as a founder CEO had investors that weren't super helpful. And so we've all had that experience of like opening the kimono and somebody's like,
yeah, and then you get yelled at.
Yeah.
It's like, not good.
Not helpful. But like, you know, is there any way for a first time founder CEO to figure that out and not have to fail once to, you know?
Yeah. The way I learned it actually is I just had a really good teacher who just took the time to tell me, hey, never market to the board. They're your partners in building the business, right? And they can't be good partners if they don't have the same facts and the hard facts that you do, right? The thing that I realized went along with that advice is actually who you choose to be on your board,
Right?
right?
Oh, for sure.
Because if you make the wrong choices about who's on the board, like doesn't matter what you do, you still have this dynamic that is not partnering to build the business, right? You have the auditor persona or the let me be a jackass persona, or I don't even know what you do persona. I just show up, right? Like,
But even still though, there's got to be times though, yeah, because again, I went through this in my previous companies, like where you just don't, you don't want to have to make the call. You don't want to have the conversation.
Right.
well, I mean, bad news sucks. There's no doubt about that, right? Like hard shit is hard shit. No question about it. And I think what I was gonna say can be done for first time founders is guys like you actually at the beginning, before you invest, have a conversation about, hey, what's this look like, right?
Yeah.
Putting together a board, putting it together first time. Maybe you made a fast wrong choice or choice you don't love with your first investors. Cool. Let's talk about how we work together, go forward, right? I'm building this with you. I'm on the same side as you. Don't sell me. I bought in already. Deal's closed. Now let's start the work together. Here's what work together looks like. And like my experience is you make that so phenomenally easy. Like so easy. Remember when I had that CMO who bailed out like after having a start date? Like that was just so shitty. I call you up and you're like, oh, I must feel like getting hit in the stomach and getting the wind knocked out of you. Like,
But yeah, but that's a good point
like.
though, where Jeff's a little different, but where I think, you know, what I think any board member could do differently is like what no one ever did in my previous companies was, you know, I never had a board member who was like, who like gave me like a pep talk and was like, I'm on your side. Like, I don't care how fucked up it is. Like, just call me and I'm not going to yell and we'll figure it out together. No one ever told me that, right? So like I had to learn it the hard way that like, hey, if I sit on these problems, they're just going to get bigger and blow up in my face. And it shouldn't have taken me 3 companies and God knows how many tens of millions of dollars to figure that out.
It only took me 1 company and 40 million.
But I think also there's a certain amount of pressure you put on yourself, particularly when you're a younger founder. And I remember feeling this. I started my first company when I was 25. And I would go home every night with just like this immense amount of pressure. And I didn't really feel like there's anybody I could talk to about it. Of course, I'm like going home to roommates who are like, you know, playing Xbox and eating pasta or whatever. But I do think that part of our role as investors and board members is to try and release that pressure valve. I remember founder CEO who you both know well, who's younger and raised a big round at a very big price in December and called me in February as COVID was hitting, was like, dude, this is starting to get real. And I said, look, the first thing you need to think about is that round and that valuation, that's over. That is a different era. We just moved into a new era and you need to forget about that. And he's like, right, but you led the round. I'm like, I don't give a shit. I just want to make sure this company survives the pandemic the next 3 months or however long it's going to be, because I believe in the long-term thesis of the business. Yeah. We're going to kick ass whenever it is over, which is now actually true 6 months later. But I think part of and maybe I can help other folks think about this, part of your job as a board member is to release that pressure valve, right? Just come out and say it. Like, don't make, you're not in a Cold War negotiation.
But it's the same way. It's like the same way, and Deidre, you're probably the same way too with your executives. Like and often I don't even have to say it explicitly, but like I've tried to create such a safe space where it's like, I don't care how badly you fucked up, just tell me. I'm not going to freak out. Like, it's all good, And I think if, boards and investors in general, I think could probably just do like a better job, creating a safe space for the founders. Because otherwise the younger founders are just going to try to pull off some heroics that are going to drive their company into the ground.
And they're going to use the same instincts that got their company where it is, right? Which is be tenacious as hell and just try and like plow through. I think explicit conversation is where it's at. Like, if you don't actually have the conversation, neither of you actually know what the rules are.
Yeah.
Right? Like how we're going to engage, unless we talk about how we're going to engage.
So both of you guys have been amazing at raising money. It probably didn't feel that way along the way, but if you sort of look back in hindsight, I mean, you have great investors around the table. You've raised money. You've raised the right amount of money at at good valuations. Your businesses are real. Like, you didn't raise money on artificial ideas and hope and dreams. Can you just talk about fundraising and sort of how you approached it and how you think about it? And maybe this would be more for folks that are earlier stage entrepreneurs that are stressed about it, trying to figure out it. Of course, they're getting advice from like 1,000 different people and blog posts and tweets and everything else. Break it down simple for us.
So Ryan, this is our tweet. We have the same approach, and there's a bunch of people who don't
think everybody agrees with it.
I think we both believe in creating relationships before you're raising money. And I think we both believe not creating relationships with every VC that emails you, which would be all you did all day long if you took that route. But my model is, okay, who are the 5 firms and partners that I think are really going to be helpful next? And then I answer those emails. And if I don't get an email from them, which frankly, after your B, you will get an email from them. If I don't get an email from them, I'll reach out to them and build a relationship when you're not raising, and just stay in touch. And Jeff, that took us from a B in March 2019 to a C at more than 2x that value 7 months later.
So why is that advice? Like, I agree with you. That's the advice you and I chatted about. I mean, I knew Ryan for a year before we invested. I knew Garrett for 3 years before we invested. Why is that advice not, like, I feel like there's a prevailing mantra somewhere somebody's preaching, saying, oh, don't meet with VCs, don't build the relationship, just run the hot term sheet process. And to me, it just seems crazy. Why would I want to just meet somebody and take their money 30 days later?
You get like 100 inbound from VCs, right? And you can't go respond and engage with them all. That would be like all your time. It's the part that's missing is be super selective about who you're going to build a relationship with. For sure, you can network and build connection with 5 people. You're interviewing them.
Yeah.
And to be honest, that's what I'm doing in the few conversations I'm having with people who might lead our next round is, hey, okay, this is like a marriage, and I'd be marrying you into the steep side of the mainstream market. Do I want to be at the table with you? Do I like you?
And were you guys doing that at the early stages as well? Because now you're in a position of strength, right? You've got good businesses, great ARR, good metrics, incredible management teams. Like, now you're in a position of strength. But back at the seed stage, we all know it's hard, right? You're pitching hope and dreams. It's you and a dog. Ryan, I think you told me a great story about how when somebody actually had a request, it went to you. You're like, hello, customer support. But like, how did you think about who you raised money with at the early days?
Well, I think your existing investors can be a really good source of just kind of gut checking, like, is this person for real or whatever, like things that you're not going to know, particularly if this is your first time starting a company, is that like, investors, whether they tell you that even if they tell you they're stage agnostic, like there are Series A firms and companies that do that kind of thing. Right. But like, when, I won't name names, but when some of these more aggressive growth stage firms come in and are trying to pitch you on like a Series A, like, they're probably not the right people to be talking to. Your investors will be able to tell you kind of like who's worth spending your time with. And so, Electric, like right after we raised our seed and we announced it and we knew we had product market fit, and I knew the story probably wasn't going to change a whole lot. I went back to Mike Brown at Bowery and Brad at Primary, and I was like, hey, I think I just want to start grabbing coffee here and there with some folks that could be a good fit. And what was great was like, I found out that there were certain people who, you know, after the first meeting, I'm like,
Not them.
not really for me, right? Not terrible, like not for me. I mean, some were terrible, but most were just kind of whatever. But you know, then there were the folks who were like pounding their fist on the table, like, I've been waiting for this business for 5 years. Like, would you take money now? And it's like, okay, like now we're getting warmer. You know, so I think we spent 17 days
I
raising.
think I was more in that camp, I hope.
Yeah.
And is there a you know, is like, but there's a certain Zen-like quality you get when you're a little further along in your career, you've done it a few times, you realize the world isn't going to end when somebody tells you no. What advice do you have for founders and entrepreneurs who are dealing with that? Like, okay, I've gotten 9 no's.
Yeah.
You know, I mean, I have my answer, but like, what do you tell entrepreneurs that you're advising and helping when they're getting all those no's?
You know, when I raised the A for WorkBoard in 2017, it was brutally hard.
Yeah.
I was like, shit hard. And I still have a list of payback people that are still on my shit list from them, from that time. But I probably got 35 no's. I had a yes really early on, somebody who bothered to build a relationship way before I was raising, which is Nagraj at Microsoft.
Yeah.
And his first look was, oh, this will be a category. Let's go find a co-invest. Now he looks back and says, damn it, I should have led it and taken it all myself. But it was hard and it was a slog. And I think the single thing I would tell other people out there is, don't believe anyone's A is easy. That's a lie.
Total bullshit. I agree with that.
If there's an exception, it simply proves the rule that early fundraising is hard. So just like,
yeah.
wow.
Well, like, I can look at our Series A and be like, I basically like raised it the week after I got back from my wedding. But the thing is the only reason it went that quick was because we were supposed to raise it the October before, and the numbers were totally not there. And I just agreed with like Primary and Bowery that they were like, let's put in another $1 million because we believe that this is going to be huge. So we would like to earn more and you would like more time. Mm-hmm. And so it kind of worked out well for everybody. But like that was a whole thing that God knows how much time. So then when we finally did it, it was actually like our second go at it, you know?
The coverage of the quick fundraisers always drives me crazy. It's like in the venture world when somebody says, yeah, we raised our $1 billion fund in 2 weeks. I'm like, well, you raised it in 2 weeks, but you spent a year cultivating those LP relationships and giving them up. Like, it's just, it's a false narrative.
But I guess to answer your question about like particularly for the founders, like, you know, dealing with rejection, like I'm sort of a big fan of this was like an old samurai tactic. And actually on the wall in my office, I have these, I don't know if you can see these Japanese samurai paintings that are like 200 years old. But what the samurai would do before they go into battle is basically just think about all the ways they would die before they went out. And then you just get super comfortable with it. Like, okay.
Right.
All right, sweet.
Right.
You know? So then by the time they went out there, there's nothing that could happen that would be a surprise.
Right.
That they weren't already cool with, right? And that's like kind of the same, like every single, whether it's a fundraise, whether I'm going to a call to recruit, you know, a candidate for a key position, whether it's a big deal we're trying to close, like, I just like, it's kind of screwed up, but I always think about like the worst that can happen is that I'm told no, and I should assume that I'm going to be told no. And here's probably the reason why.
Yeah.
And then when you're told no, you're like, okay.
Yeah.
So one of the questions I got from Evan Lewis is digging into that top 5 firms point. Let's say a new VC approaches you, one that hasn't been on your radar for your top 5 firms. If you have 5 minutes to look into them, what do you look at to make that judgment call on whether they're worth chatting with? And do you ever shuffle your top 5?
Hi, Evan.
Good
yes,
question.
I shuffle. Yeah, I think actually you're constantly shuffling that top 5, right? Because there's discards, right? Which is, it's not, that it didn't work, the connection didn't work. And for me, the single biggest, like the first order question is, do they see the same possibilities I do or more on the same trajectory? Not a different market. And not that they can't quite see it, that they think they can see my numbers. They got to see my market. And if they can't believe and see the possibilities, then they're not going to be great partners with me on exploiting those possibilities. Like that's way harder. And I think that's why the A or your seed, whatever it is, why that's so hard, because very few people can see what you see at that point. Now, later stage, you still have to do that diligence because a bunch of people will just look at the economics and won't get the soul of the thing you're creating.
Yeah.
So that to me is how people fall in and out of those top 5. And then
But I think your point about them believing in the market is a big one, right? They have to come in and say, I believe this market's here. I want to figure out this is the right team, product, company, et cetera. Mm-hmm. Yeah, it's always annoying as a founder when you're sitting with somebody halfway through the meeting, they're like, how real is this market? And you're like, well, what the fuck are you sitting here with me for if you don't think it's a real market?
Yeah. Or they tell you how strong they are in another market that you just said you're not in.
Right.
Okay.
Yeah. Well, one thing that I've done, I'm not recommending this, by the way, but choose to follow it, fellow founders, if this sounds interesting. When a firm's really interested, if it's not a warm intro, like if it's just somebody coming inbound, like, hey, heard a lot about it, whatever, I usually ignore the first one and then wait for them to follow up, and then sometimes ignore the second one. And usually by the third, they're like, listen, we've done a ton of homework on this space. And then they'll share the homework, and then you're like, okay, all right, you actually know what you're talking about. Like I had a firm just do that the other day, and I think by their third email, they were like, these are all the reasons why we are so bullish on the space. I'm like, I'll take that call.
Yeah. In fact, one of the things I always try to do in a meeting, in fact, I did this morning with the founder. I said, look, I believe in your market. 100%. I believe this market exists. I'm just trying to understand your business and what it's going to look like 3 to 5 years down the road and how you're thinking about it. Like I believe this market is big. It's super annoying when you get somebody that's sucking up your time, trying to get you to educate them on the market. That's frustrating. So we have a couple minutes left. What do you guys think happens over the next 6 to 12 months? Like, I'm just curious how I've got several founder CEOs that have sent me texts saying, hey, where are things going in the next 6 to 9 months? We're trying to make some calls on the business. What are you guys thinking about?
I'm doubling down, right? Our business is growing. There was this freeze, sort of everybody in April in particular, just sort of paused like, okay, wait, what does it mean? And then by May, we realized that the sun came up the next morning.
Right.
Right? Like, oh, okay.
And you're seeing it.
We just keep going, right? Where we are now, I think, is we've habituated to what is. And we've habituated to it. And actually, the adaptation broadly is pretty amazing. So my view is you build the business you were always going to build, right? You pay attention to the way consumption pattern changes and what the day-to-day experience of your users are. I think that's important, but you pay attention to that so you can maximize value to them, value to you. But we're investing more. We actually didn't lay off. We hired aggressively during the last 6 months, and we'll just keep going. And I'm incredibly bullish on the next 6 to 12. Like, I'm not blinking.
Yeah. How about you, Ryan?
Yeah, same point of view. I mean, obviously it's like kind of sector specific, and, you know, as long as you're not in an industry that, you know, has been kind of rocked by all this, like at the end of the day, I mean, specifically if you know, this is someone in the startup world looking for advice, like if you're in the business of building software or technology in general that makes people's lives better and replaces something that sucks, high level, you're at the right place at the right time, and the capital markets are friendly to those concepts. So stay focused and be aggressive.
Yeah, I would tell you that Deidre and I just had this conversation, I think yesterday, where like anecdotally, we're super bullish on the back half of this year and heading into next year. I mean, I think we're going to see a major boom in technology spending. I mean, you're already seeing it reflected in the public market, as you just highlighted, Ryan, but like, you know, think about every business that gets created in the next 6 to 12 months is going to be built on technology, right? You're not going to start a new restaurant today without delivery and takeout and a mobile app. So there's just going to be a huge wave of adoption and spending on tech. I
think the big moral of 2020 is if you have a process that isn't digital in 2020, you don't really have a process.
Right. Great way to put it.
Sort of think about all the areas of our business that were managed by walk around and Excel trackers, and you had to have the right file to know where.
Well, yeah, and like a digital spreadsheet is not a digital strategy.
No, that is not digital, right? Yeah. And that's the moral of 2020. That's what it means when we all go to our homes and start to work, is the interstitial tissue and data that connects us has become 10x more important.
Yeah, and the companies that are run with technology are running better, right? They're running more efficiently. So cool. Well, thank you guys. Thank you for the half hour. I appreciate it. This has been great. And as I said, we did it unscripted with no prep, and you guys nailed it. So thank you for the time. I appreciate it.
It was fun. Thank you.
Thank you.
Thanks, guys.